In Western and Northern Canada, Crowe MacKay has been the trusted accountants for your business. We listen, we analyze, we advise. Come to Crowe MacKay for smart decisions and lasting value.
And good morning, everyone. Thank you for joining us here today. Welcome to our webinar. It is Audit Readiness 101. I'm Brittany Petruniak, the Director of Marketing and Communications here at Crowe MacKay. And before we begin, I would like to give each of you a moment to acknowledge and respect the lands that you're situated on. So for myself, I am located in Vancouver, and I would like to thank the Squamish, the Tsleil-Waututh, and the Musqueam people for allowing me to live and work on their unceded traditional territory. Today, I'm joined by Fred Deschênes and Aaron Halladine, two of Crowe's trusted advisors who will discuss how your business can prepare for year end. Fred is a partner in our Yellowknife office, and he's been with the firm for over 10 years. He is one of our leaders in our audit practice, and he serves our not-for-profits, municipalities, school boards, Indigenous community organizations, and those are just to name a few. And Aaron, he is a senior manager and he's working out of our Kelowna office. His background includes serving leadership roles previously with the Office of Provincial Auditor in Saskatchewan. And now he specializes in serving clients in government, ministries, healthcare, and the nonprofit sectors. So thank you both, Fred and Aaron, for joining me today. Just before we move into the webinar, as you can see, we've got the screen pulled up here. I want to bring your attention to the bottom of your screen. There is a Q&A option, and that is how you are going to interact with us. So we encourage you to ask your questions throughout the entire presentation, and at the end of the webinar, we will address those. So if you have any help or you need assistance, there's also a chat button there, and we're online ready to help you. So a little bit of who we are. We are a team of 400. As we've mentioned, we're situated all across Northern and Western Canada. We have 8 offices. We're in Vancouver and Kelowna, Calgary, Alberta, Yellowknife, Whitehorse, and along the Sunshine Coast. As you've probably noticed, we also, as you can see, are part of Crowe Global. We are a member firm, and that means we are a member of the top 10 accounting network in the world. This means for you, you get access to more expertise and more resources as we have a larger team spanning around the globe. We work with businesses on succession planning, on SHRED, on your tax incentives, on intellectual property. If you want a digital transformation and moving your products to the cloud, cybersecurity, implementing and enhancing. Those are just to name a few of our services outside of what you would probably traditionally know your accountant in doing tax or audit. So if you have any questions on any of our other services that we offer, I encourage you to reach out to your trusted Crowe MacKay advisor or reach out just to your local office and we can connect you with one of our expert team members. So other than that, we're going to get right into the audit. Fred and Aaron, I'm going to hand it off to both of you, and you can let our guests know what they can do to make their lives easier going into their year end.
Thanks, Brittany.
Thank you.
So we have a little bit of an agenda for you guys today. We're planning to start off with the planning for the audit, preparing your financial statements. Then we're going to walk you through a few tips and tricks to prepare for the audit. Once we've done that, we're going to have a quick discussion about the impact on the business, and then we'll have some closing remarks. And then, as Brittany mentioned, we'll have some question and answer period at the end to answer any questions that you may have. So who is this webinar intended for? This webinar is for individuals new to the controller or finance position and having to get ready for audits for the first time. As well, it's for experienced controllers who want to confirm that what they are doing is okay or want to improve on current processes, i.e. to make sure they're not missing anything. So let's begin. Planning for the audit. First thing you would want to do is to start setting deadlines and timelines. Set schedules when activities will be done, e.g. inventory counts, your capital asset counts, etc. Set the date in your books that your books will be closed. Establish processes or steps to ensure all activity around year-end is recorded. Best practice would be to have a year-end memo to send to staff so they know what is to be done, e.g. tracking sales around year end or purchases around year end to ensure they're recorded in the right period. These are done in a log or a specific module of your financial system. So e.g. the PO systems or purchases or the invoice program for revenue.
So Aaron, what would that mean for a client? Do you think a client would be looking mostly at like what's their year-end date and working that way from there? So your year-end date, say some year ends are December 31st, and they would be looking at that as a starting point to set their deadlines and also their reporting requirements as their deadlines. Either it's tax, it's the bank, or it's the funding agencies they're working for. They would have reporting deadlines for that as well. And then from there, they could work their way from their year end to the deadline and have the audit somewhere in between. Is that correct?
That is correct. So yeah, you definitely want to set, if you're December year end, as you say, set the deadline so that you have, okay, I need to have reporting to my funders by, a month or 2 months after year end. So we need to have the audit somewhere in between. So we need to make sure that right at December 31st, all the processes are done. So if it's a variety of things that need to happen before year end, you would start working backwards. So yeah, you're correct. Your deadlines are important.
Yeah, so you work from your deadlines and then you work your way into your audit, preparing before your year end and then closing your books after year end so that you're ready for the audit at the audit deadline or the time, the field date for the auditors to show up at your office or have the documents sent out if it's remote auditing, as we've seen in the last few years. So
that's correct. Okay. So the next step is to create what we like to call an audit log or a diary to address audit planning inquiries. And this log we recommend should be kept. It's a summary regarding activities that occur during the year. So, for example, change in operations during the year, significant transactions, unusual transactions, new or large contracts, change in key personnel. These are areas the auditor will always ask about, and though it may not eliminate all the questions, it will definitely reduce the amount as well as reduce the follow-up questions when the auditor finds an item not mentioned to them previously. Okay. After you've done the log for the year, the next step is to schedule the audit in advance. And as we kind of alluded to already, by scheduling the audit in advance, you're able to determine the most efficient location, one, to have your auditors to minimize the impact to your current work, and then to minimize the disruption to your staff. As well, you're able to ensure that the staff is available to provide the audit support and to keep current operations functional. Ideally, you would be able to have the audit in like a less demanding period for the business. So if you know payroll is going to be at a certain point and you need to have the audit at a certain period in time, you want to not hit the payroll period, you do it slightly after or before.
Yes, the earlier you schedule the audit with your auditors, the better are the chances that you're going to get the audit at the time you would like the audit to be. And that's more convenient for you and also more convenient for the auditors as well. And it improves on the service you get at the end of the day. So that's really important. It also gives you a goal to look for at some point in time. So yes.
Okay. So the next item we want to quickly cover is preparing your financial statements. And I know this is a little bit scary when people say prepare your financial statements. Though not everyone prepares their financial statements, you are responsible to prepare the support for the information included in your financial statements. The auditor will also ask questions while testing specific account balance. Regardless of the financial statements section, most of these questions can be addressed through detailed documentation for each financial statement balance. This means for each line item in your financial statement, you need to have the support ready when the auditor begins the audit. The plan today is to walk you through some tips and tricks for the more unprepared sections, but please note that what is provided is not a comprehensive list. And so if you have areas in your financial statements that typically get adjusted by your auditor, reach out to see what you can do to address the issue before they arrive.
Interesting fact that you mentioned here, Aaron, is that management is responsible for providing support for the financial statements, but also management is responsible for the preparation and fair presentation of the financial statements in accordance with the framework that they prepared their financial statements under, and it says it right in our engagement letters, and it also says it in our auditor's report what management is responsible for. We will assist with the preparation of financial statements in a lot of cases, but it's management's responsibility at the end of the day to do these things. So it's very important to note that. So.
Okay, perfect. So let's get to the tips and tricks to prepare for the audit. What we're about to cover now used to be referred to as the year-end audit binder. What is being presented are expected support for the financial statements and notes. In the past, this used to be a physical binder of documents, e.g. your bank recs, your aged accounts receivable listings at year-end, and listing of receipts after year-end, etc. These items no longer need to be manual, but can be electronic. For each line item in your financial statements, there should be a folder to provide to your auditor at year-end. In the next few slides, we have provided a few examples of what each folder should contain. When naming the documents, make sure you and the auditor agree on the naming convention so that when the auditor asks for the support, you both are talking about the same thing. Often this creates a lot of confusion and wastes time for both parties. So the first item we're going to cover is cash. All significant bank accounts need to be reconciled. Work with the auditor to identify which ones are significant. The less significant ones may not need to be reconciled. Keep a listing of payments and receipts that occurred prior to year end. I would suggest the last week before year end. Keep also a listing of payments and receipts that have occurred after year end and up to the fieldwork date. The auditors typically ask for these listings because they assist them in some of the testing that they have to do around the cash account.
Yes. Aaron, the important thing to note here is that the bank are reconciled and that it's documented. So those are procedures that should be on an ongoing monthly basis in most cases, and that at year end it's done properly, and maybe a extra attention at year end to look at what's in your outstanding checklist to see if there's anything out there that should be fixed before the auditors start doing the financial statements or doing the audit of the financial statements. So that's something to look at. And then the rest of the information is also something that you should keep, but pay attention at close to year end to make sure that cutoff is appropriate. And what we mean by cutoff is that the proper transactions are recorded in the proper period. So I just wanted to add to that. So
yeah,
thank you.
No, perfect. So the next account that we often see some issues with is the accounts receivable account. There should be a listing, and typically this is your subledger, so make sure the subledger is up to date. This listing should outline how management have assessed the risk of collections. So e.g., if it's 30 days, 60 days, or 90 days before you start kind of worrying about bad debts, or if it's specific identification of uncollectible accounts. That should be documented. The auditor is likely to request an assessment of your collectability for these accounts. So if you've done it beforehand, it's there to provide, and you can provide the support or explanation behind why it's done that way. If you have provided a reason, and this then gives the auditor information to work with and to seek out support for your reason. If the support payment, if the support is payment subsequent to year end, the listing of receipts that we mentioned with the cash would be a very useful item as well. So the key here is to make sure you have this listing prepared and your risk assessment is done, because the auditors want to understand management's perspective as to why they've assessed the risk they have.
That's basically what we're looking for. When we're doing the accounts receivable, there's collectivity and the evaluation of the accounts receivable, and that's done. You've got your regular accounts receivable, and then there's an assessment you need to do on the allowance for doubtful accounts or bad debt that you have included in those accounts receivable. And it's to look at, what's above 90 days and what do you think you can collect from these individuals or businesses. And it's, are they still in business? Are they not in business? Can they pay? Can they not pay? And with COVID, the last few years, some businesses are struggling. So you have to pay special attention to that, because you might have $100,000 in your receivable, but if only 25% are within the 60 days and the other 75% are 90 days and over, there's a risk that collectivity and your valuation of your $100,000 is not what you're going to get in cash down the road. So you have to look at that for your business purposes, but also your reporting purposes. So that's something to look at.
Perfect. So the next area we're going to go to is your capital assets. And for this one, it's typically not done as well as we'd like to see it. What we'd usually like to see is a schedule of assets that is maintained by the business. So what do you own, where they're at, when they were purchased, that type of thing. Ideally, all assets should be counted and verified that they still exist annually, but at minimum, a listing of additions and disposals should be kept on an annual basis. That way, the auditors can work with that to kind of create, what they need to do or test the items they need to test. I would recommend that you keep this electronic so as to assist the audit work that needs to occur.
Yes, an interesting part of a business is the assets that you need to operate, and those would be vehicles, buildings, and things like that. And some things are smaller, but you want to keep a listing of what you actually have and operate with. And every year you will get rid of some equipment, or you will dispose of some equipment, or there's some equipment that's not functional anymore. And we need to know that as auditors to make sure that it's not, in your books anymore, and it's taken out of your books for whatever you don't use or you dispose of, or it's not amortized and there's proper valuation for it again. And whatever you have acquired, you've also included as a tangible capital asset or as a property, plant, and equipment at that time. So tangible capital asset is the public sector accounting and ASNPO term for property, plant, and equipment that you would have in a business. So if we alternate between tangible capital assets and property, plant, and equipment, they mean the same thing, just different reporting standards.
Yeah, and one of the items that most clients don't typically do is the amortization expense. If you are looking to do this, you probably want to reach out to your auditors. They probably have a continuity schedule that has this calculation in it, and they could probably share that with you so you can actually at least do the preliminary work on it before year end. If you have doubts as well about whether an item is capital in nature, the best recommendation is to include it in the listing and add a note for the auditors, or reach out at the time of acquisition. They'll probably be able to give you guidance on how the item can be recorded. Okay.
That's a good point, Aaron, because we audit organizations that have very small organizations to medium to larger size organization, and depending on the size of the organization and the capacity to keep their certain financial records, some auditors will have that continuity schedule for tangible capital assets, whereas other organizations will have their own listing that they keep track of, and that's just a function of the size of the organization and the capacity to maintain this kind of format. So I just wanted to add that, because it's not, when we're studying as auditors, it's not an expectation that we would do this, but as reality sets in, sometimes we are, for lack of a better term, better suited to do it, better, in a better position to be able to provide that service. But it's an additional service we provide in an audit, especially for smaller and medium organizations. So just thought I'd point that out.
Okay. So next we want to quickly chat about accounts payable. Again, like AR, this is likely a subledger printout for items which you've already received an invoice prior to year end. If you haven't received an invoice prior to year end, what you typically want here is what we call the accruals. So you create a listing of items that you've purchased. You have received the items, but you have not yet received the invoice. So those items should be accrued for and then put into the financial record so that they end up in the proper year. A good point to go to here is your PO system if you have one. If you have a PO system, it will definitely identify all your open POs, and you could probably run through that listing and identify which ones need to be picked up for items you've already purchased and received, but have not yet received the invoice or have yet paid.
Yes, I think also we focus on the PO system, but a lot of other organizations have different types of, purchases and expenses, and sometimes it might be government organizations that have staff that have expense reports, and maybe it's time to, put in a cutoff date for submitting expense claims close or near year end, or maybe a couple of days after year end, so they get captured in the accounts payable in the correct period. So somebody at, if you have a December year end and they traveled just before year end, and then they accumulate a bunch of, hotels, gas, things like that they need reimbursed, maybe they'll submit the expense claim in, maybe February or March. But if your auditors are coming in February, you need that accrued liability recognized before that. So the deal is to have, a memo go around to make sure that your staff comes back with their expense claims on time. So little things to think about in your business to make sure that you capture all the proper expenses at the right period. So.
And as we move through the AP, the other side to that is the wages and benefits piece. So wages and benefits, which include vacation payable, your lieu time payable, and things of that nature. Salaries and benefits that relate to the current year being audited, but will be paid in the new year needs to be recorded. So if you are at December year end and your last pay period started on December 27th, you'll have those 3 days or 4 days till December 31st that need to be recorded in the current financial statement audit, even though it's going to get paid in January. So that calculation is going to depend on how staff is paid and what benefits they receive, but work with your auditors to develop a template if one is needed. If you don't need one, then it should be a simple process of going, okay, it's 14 days, the person earns X amount if it's salaries, and you calculate that much for the year-end period for how many days remain.
And the benefits would be things like vacation, sick days, time in lieu that you would accumulate in a spreadsheet or maybe in your accounting system, and then have that as an accrual in your financial statements. And vacation is one of the ones that we test normally, especially if there's a risk. The number of days that are accumulated or the number of days that were used during the year are not properly tracked. So make sure you track those properly in different systems, and that you keep a good record of those vacations and sick days, things like that, so that it makes it a lot easier for us to audit, and a lot better for you to keep control over, how many days does a person have, how many days they've taken, and then record the financial impact on that, at least at year end.
And it definitely helps if these individuals do get paid out these items at a certain point in time, for instance, when they are retiring or something like that, if they do get that. So a good track record of these items is always important. Okay. Next, we want to quickly go over investments. Similar to the capital assets, investments should have a continuity schedule. If there are investments, you should definitely be recording them so that you track the purchases, the sales, the gains, the losses, the market value, the book value of these investments. More often than not, the standards do require you to disclose several information about investments in the notes. So look to your financial statement notes to see what the auditors have done in the past, and make sure that your system or process is capturing that type of information. If it's not, then your auditors have to recreate it, and that's going to take time.
One thing to note as well on investments is that you're probably going to end up with two different values, because you have one value of investments that's for taxes and one for reporting purposes. And as a result, you will get two different reports or two different schedules, depending. It might be on the one schedule, but you need to keep track of those two amounts. You can't just go, I'll just report on taxes and keep my investments for taxes, because for financial reporting purposes, you might have a different reporting standard. So just wanted to point that out. So don't go repeating that the auditor said that we could keep two sets of books, though. It's not the same thing. It's a set of book for taxes and a set of book for reporting, but it's not, I'm not telling you to do something bad here.
Yeah, and again, reach out to the auditors. They'll definitely give you the guidance you need for what you need to track. Okay, prepaid items. These are typically insurance policies, IT contracts for maintenance or support that cross the fiscal year end. You need to track how much of that payment will be used in the next fiscal year. The commitments listing that we'll discuss a little bit later will be a helpful guide here. But more often than not, we don't see a lot of prepaid listings being prepared. The next item, we're going to quickly go over our loans. Depending on your accounting standards, a lot of disclosure is required for loans. Therefore, all the necessary loan reports, e.g. year-end mortgage statements, should be obtained. If multiple repayment schedules, a summary schedule should be done. Use your prior year statements as a guidance to create your summary statement, because that information is going to roll up into the notes if it's disclosed in the notes.
One other thing, I always start with that right when I come on. One other thing I'd like to mention is that the terms of your loan always or sometimes have covenants, and you should keep track of those covenants during the year to make sure you're not offside. And if you keep calculation of that, show it to your auditors as proof that you're onside. And if you're not onside, get in touch with your auditor, and also probably consider communicating with the bank about the reporting requirements required for that. So just another important thing to do before you get to the audit, and the auditor kind of looks at your financial statements and recognizes that all of a sudden you're offside on your covenants. So really important to look at before year end for long-term debt or loans.
Yeah, for sure. Related party balances. Depends on the standard, again, that you're using. There could be a lot of disclosures, and again, your prior year financial statements would be a great guide. If you don't have prior year financial statements, you probably want to reach out to your auditors right away to kind of go, hey, do we need to track this? Because it's something that, as you can see on the slide here, you have revenues that you're going to have to identify, your expenses you have to identify, what's owing to those related parties, or what do you have receivable from those related parties, and necessarily the terms. All that necessary information is likely needed to be presented in your financial statement. So tracking this information throughout the course of the year would be a great idea. If you're worried about who your related parties are, again, you might want to talk with your auditors to get a good idea there.
Yeah, it's a standard that has been around for a few years, about 20 years, but it's increasing in demands for reporting over the years. Even in recent years, it's always updated to make sure that all is properly captured in your financial statements. Because if there's a risk of manipulation, manipulating results in operation is with related party balances. So we take an extra look at that when we're auditing.
Tax communications. What we prefer here is a well-labeled file of all your tax communications throughout the course of the year. The other thing that you can do is to probably give your auditors access to CRA online, and they can pull information from that location because it's already in basically a central location on CRA. Now, how you do the folder is up to you. Any additions to that one, Fred?
No, all good.
Okay.
I don't do taxes a lot, so I do a lot of non-for-profit organizations and municipal governments that file very simple taxes, and as a result, I am not qualified to talk about taxes a lot. So I will remove myself from this conversation and put myself on mute.
And commitments. The other item that you want to track, and we alluded to this earlier, is these are items that are likely going to extend past the current fiscal year. So tracking them, again, is a good idea. One, it assists you with the liability side of your financial records if you have commitments, but also some standards, depending on the standard you're using, will have requirements to disclose these commitments over the next year or 5 years in your notes. So tracking this information is a great tool that the auditors can just refer to. And if you can verify that, it's a complete listing, that you've been tracking it all year and nothing's missed, then great. It lessens the amount of work the auditors have to do.
Agreed.
Okay. Like commitments is contingencies, and usually these are legal issues that could indicate a cost to the company or an event that happened in the audit year. If any such items, keep track of them. The auditor can use this listing as guidance to determine if a legal confirmation is required. So it depends on what you've tracked. If it's grievance from your employees, if it's something, a dispute between a supplier, those items can help trigger for the auditor what they need to do next. But if they are not aware of the items, it's hard for them to do the right or proper work that they need to do. So tracking this and keeping a listing of them is very important.
Yes, in reality, there's a note in your financial statements that discloses any of these matters. And if you're preparing the statements, you would, notice and add that, in your notes. And then the level of detail is, kind of left to judgment most of the time. So there's, some room there because you don't want to incriminate yourself by adding too much detail. But at the end of the day, this is something that you need to report on. And if you don't, prepare your financial statements or the notes to your financial statements, then assist the auditors into having the proper reporting and having that, in that logbook that that we were mentioning at the beginning, that's would be something you'd mention, like any legal issues that you would have had during the year that could be potential for litigation and lawsuits down the road, and potential for financial impact on the organization. So that's really important to keep track of, and during the year, including I'll leave it as is for now, and we'll go from there.
Okay. So be proactive. Time at the beginning of the year can save a lot of time at the end of the year. So the audit log, if you communicate early with the auditors, you can track specific items they will need to be aware of at the end of the year. It also helps so that you're not relying on memory to kind of provide the auditor with an update as to what has transpired throughout the course of the year.
Yes, that makes it a lot easier, because when you think about day-to-day operations of your business and things that happen, you start your year, January 1st, and your year end is 12 months later, December 31st. And let's say we're doing the audit in March of the year after. Things that happen in January, February, or March the year before, might not be on your radar when we're doing the audit. So keeping a log, most people know their businesses and know the big items that will impact their financial statements. And if they have had an impact, it would have kept them up at night. But keeping a logbook at the same time might be helpful, so that when the auditors are calling you and you're dealing with 5 clients, 10 staff, and whatever else is on your radar that day, you don't have to jog your memory that much. It's right in the audit planning log and diary, and you can just send it to the auditor and they don't have to bug you, and you can go on with your business of dealing with those 5 clients, 10 staff, and whatever else comes along. So,
and then next, as we mentioned, manage your supporting documents, have the necessary audit binder. If you've never done a binder before, auditors may be able to have a sample format you can use to help you start, or you can create your own depending on how you prefer it. Tax-related matters, as we say, you may want to just authorize your auditors to access CRA to see if there are any matters for their consideration when they're completing the audit work. And any other questions you may have related to items can actually be put through to the auditors through a period of time. So, and again, communicate throughout the year. Regular ongoing communications with your auditor is useful, especially if there's significant transactions in the year or unusual items you're not certain of how to record or how to deal with. They are able to provide you options. The auditor can also review the adjusted entries from the prior year once they're made to make sure that they're done appropriately and you started on the right footing.
yes, yeah, communication with your auditors throughout the year is good. Having a good relationship with your auditor is always, a good business practice, where your auditor will know your business. You'll have a good relationship, and it'll make the audit a lot smoother for you, your staff, and your organization, and the auditor and their audit team. So it's a win-win situation in that case. And I would recommend that you build a relationship with your auditor, as well as the auditor should build a relationship with you for your business practice.
Yeah. And so the impact to your business after all this is done is you'll have a much more smoother, efficient audit. The audit will then become a normal part of operations. The auditors will be able to focus more on value-added activities for your business, so assessment and communication on business practices or processes, and just overall, everything would just be much more efficient for both parties.
Yes, we're all competing for better service, and I think at the end of the day, offering and having a better prepared system for your purposes makes the audit a lot smoother, makes it a more fun environment for an audit. I don't know if that's an oxymoron, but I said it here, your audit may be less stressful at a minimum, and less impact on your staff and our staff while we're doing the audit. So, and then you end up with better results. When the relationship is, not going well between the auditors and the client, things can go and probably will go wrong. So it's important to have that good relationship with your auditor. So,
okay. And just to kind of sum up, review your prior audit. It's a good guide of what is to come. And if this is your first audit, reach out to the auditor to assess what they will need. Track key items throughout the year and reach out to the auditor if something unusual occurs. More often than not, something does happen but is not relayed. Once identified, it creates additional work for the auditor and extends the audit. You want to avoid this as much as possible. In an ideal world, there would be a process to ensure each financial statement line item is tracked and updated on a periodic basis, so each monthly, but at a minimum, the necessary support should be updated and be ready before the audit starts. Store documents centrally and work with the auditor to develop a naming convention for each. This way, the auditor and you now have no confusion about what is being provided or what's being requested. And I think that will make things a lot easier.
yes, I really think that as a controller or new controller in a position, looking at what the auditor provided in the previous year would be helpful to you. So obviously a copy of the financial statements, but we also issue a management letter and adjusting entries, a summary of unadjusted errors to look at, and the trial balance. So you can see which adjusting entries we had to do in the previous year, assess whether you can do those and fix them for yourself before we head out there to do your audit. And also, if there's any management letter points where they addressed during the year and where they fixed. At the end of the day, if you're really lucky, the previous controller before you was preparing an audit package that you can just follow and go from there. So, and it will be a year-to-year improvement in your audit package so that you can get better results on your audits.
Yeah, and with regards to the naming convention, there is typically, I think most auditors actually have like a common format. So like your cash section is always your A, B section, or C section is your AR. So work with them and say, okay, how do you have it labeled? So I label it the same, or how do you want it called or termed, and go from there. Okay. So that's what we wanted to kind of cover today. So thank you very much.
Thank you both, Aaron and Fred. That was fantastic. We are going to open up for questions. Before we hop in there, I am going to do a quick plug for all of our attendees. We do have some more webinars coming up in the next few weeks. We have one tomorrow, and that one is on the 2022 financial reporting and tax updates. So some new things coming down the pipes that if this applies to you, especially around ASPE, this might be of interest. Again, it will be recorded and up on our website if you can't make it, so you could get that information afterwards as well. And then next week, we have all around IP, intellectual property, and how your company can protect their assets. And in our follow-up email, we will send you links to register for these if you are interested. And we will have the link to the recording of this webinar if you would like to reference back to it or share it with your network. So we're going to go into the Q&A. I've got a few questions here that I'm going to throw at you both, Aaron and Fred. And again, for our guests, if you do have questions, please feel free to enter them right there in your chat box at the bottom of the Q&A, and both Fred and Aaron can address those. So my first question for you both, we've got, how early should you be contacting your auditor?
As early as you need to. Like, a first step would be reach out to the auditors once you've probably posted the adjusted entries from the prior year. That would be the first step to make sure everything is right and you're starting on the right footing. The second part is probably it's a continuous process throughout the course of the year. So if you run into an issue 1 month after year end and could create a problem for the end of the year audit, I would suggest you reach out at that point in time. As we mentioned in the it's not about only reaching out when it's close to starting the audit, but as issues arise or if there's something that you need some assistance or need some guidance on.
Okay.
I would say 3 months before is probably a good standard. I have clients that will book next year's audit when we're closing up 1 year audit. So if we're closing up year X, then for next year they say we should do this next year at the same time, and then I put in my scheduling request right away. So we're ahead of the curve all the time. So as you progress, and then sometimes it'll always be the same time of the year, same third week in May, we're doing your audit, and there's not a lot of changes unless things happen and things change. Like the COVID year, we had the changes that we had to what's the word that we're using these days? Pivot. And move on from that. So
perfect. Yeah, you know what I mean? For business operations, when you look at our clients and their businesses, having that plan doesn't hurt either, and making sure everyone stays organized when you stay ahead of the ball. That's great. Okay, next question. So should if someone's with their business, should their business be doing the adjusted entries before the auditor arrives?
There's really no right or wrong answer to that. You could first definitely give it a go. If you've done it and you think you've done it appropriately, put it in. The auditors can always adjust it. It may not be as big an adjustment, or they may not adjust it at all, because sometimes the adjusted entries are management's assessment of what they think is owing. And so if it's not a significant difference from what the auditors have recalculated, they probably won't make any changes.
I would say it depends on your capacity and your comfort level with posting those adjusting entries. If you've done it before and you're comfortable with it and there's no issues, then definitely post them. But if you're not confident, or you're not sure if you're going to get, for lack of a better word again, the right answer when you're posting those entries, you probably should take a step back and maybe ask your auditor for assistance at that point to see if they can help you and how they calculate that and go forward. At the end of the day, it's your choice, and whatever makes it more efficient. What risk you want to avoid, and what risk as auditors we want you to avoid, is you putting a lot of time trying to post these entries and then us auditing and finding out that you did them wrong. That might be good for 1 year, and then you could fix it the next year, but it's just something that, if you know you can't do that and you don't have the capacity or the knowledge to post the entry, take a step back and let us assist you in doing that work for you. So
yeah, you could also probably run the adjustments. Like if you've calculated and I'm not comfortable with the posting, but this is what I've calculated, the auditor can look it over. And again, if they need to do it on their side to propose what the entry should be, sure. Yeah.
All righty. And my last question that I have here, if someone's feeling overwhelmed and you could give them one piece of advice, one thing that they should just focus on to help them prepare the most and be ready and helping their auditor out, what would that be?
One piece of advice.
As you're like, no, we just did a presentation. We have a laundry list of things.
Well, I guess the key would be to if you're not comfortable with the preparation of a lot of the items, keep track of all the activities throughout the course of the year that have happened that the auditors would probably need to be aware of. That would be the bigger one, I would say, to do. But there's no real right or wrong answer. It'd be great if you could prepare your financial statement line items, but if you're not comfortable with that, then at least keep a log of what's happened. And or how things transpired around year end, so the auditors, when they are probably doing their reassessment, can fix some of the items that need to be fixed, if anything.
Okay. Anything to add there, Fred?
Yes, definitely. I would say if you're feeling overwhelmed or stressed out that your auditors are coming, I would say take a step back. If you've done all the work you were supposed to do throughout the year, there shouldn't be any issues. Like, have the basic bookkeeping, your bank recs reconciled, or retained earnings reconcile. The rest of the books are kept on track. There should not be any issues. The rest is just year-end entries for reporting purposes, and we can work through that as auditors. It shouldn't be too much of a stressful situation when your auditors come around, and that way, I feel that just take a deep breath, and we're here to help you. We're not here to to make your life miserable. Although I understand that, business being business, you probably don't get like downtime, like an extra 4 hours in the day because the auditors are around. So you probably have to work an extra 4 hours because the auditors are around. And as a result, doing the process of preparing an audit binder will reduce your stress, because we might not require your assistance. So you won't need an extra 4 hours in the day because the auditors are there, but you might still need an extra 2 hours. But I would say take a deep breath, and if you have constant communication with your auditor during the year, you're used to them and you're used to their team, and just talking to your auditor might make it a lot easier for you down the road.
Okay. Awesome. Well, that's all the questions that I have. I'm not getting any more in here. So with that, I think we can wrap up. Thank all of our guests. Thank you, everyone. And again, if you do have any questions, contact your local trusted advisor, reach out to Aaron or Fred, or you can also call our local Crowe offices. We will have all that information coming to you in a follow-up email this afternoon. So thank you, everyone, and stay safe, and we hope to see you soon. Bye-bye.
Yeah, thanks.
You. Okay,
Bye.
bye.